Hey everyone, in this video I'm going to be sharing whether I am bullish or bearish on the US stock market, why I currently hold this standpoint, and what I think people need to keep their eyes on as things progress. At the end of this video, I'm going to share what we'll be covering next and how this will help all of us navigate the uncharted financial path ahead of us. Also, if you're new to the channel, I'd just like to say welcome, and I really appreciate all your support, and I look forward to doing my very best to be your guide and make sense of this crazy financial world that we find ourselves in. I'm on a wave, slept on, no, I got next on. I'm on a wave, I'm on a wave. Before I share whether I am bullish or bearish on the US stock market, I'd just like to make it very clear that no one knows exactly what's going to happen or when it's going to happen. And so I'm just here to share my perspective and what I think is the most likely direction that the stock market will be headed towards for the next couple years, given all the information I have available to me at this time. With that being said, I am currently very bearish on the US stock market, and let me share why. One reason I am extremely bearish on the US stock market is because corporate buybacks have been the largest single driver of US stock prices in the last 10 years. Here's a chart of the S&P 500 here in blue, and in orange we have corporate buybacks quarterly. Corporate buybacks take place when companies go into the stock market and buy up their own shares in order to increase their stock prices. Going all the way back to 2011, corporations have bought up at least $100 billion of their own shares every single quarter. Going back to the last quarter of 2018, when the stock market had a steep 20% decline, corporations had their largest buyback spree on this chart, totaling over $200 billion just in that quarter. While this is troubling alone, it's also concerning for the future projection of the US stock market because it's been so reliant on these massive corporate buybacks every quarter. While most companies are struggling to bring in as much revenue as they were before the pandemic, and a lot of companies are facing bankruptcies and are relying on government bailouts, this is a very big concern for the stock market because it means that not as many companies will be able to continue buying back their own shares. The next reason why I am extremely bearish on the US stock market is because small businesses, which I've talked about in my previous videos, are the root of the real economy, are really struggling to stay in business. With so much increased regulation since the onset of the pandemic, in addition to more expenses and in most cases less revenue coming in, companies are really reliant on continuous aid from the government. In this current situation, businesses are trying their best to decrease expenditures so they're able to stay in business. And so they're having to lay off more employees. And this implies that unemployment will stay high for a longer period of time. And this is not a good setup for the economy and ultimately the stock market. Another reason that I am bearish on the US stock market is because I think the market is very overpriced overall. Here's an update on the Buffett indicator. Right now, it is currently calculating a likely return of negative 2.7% per year, given the current valuation of the US stock market. So if we look at the total market cap compared to GDP, we are now approaching 180% of GDP when we compare the total market cap to GDP. Here's another way of looking at it. We've got in green GDP, and in blue, we've got the total market index. And so this represents the whole market. Right now, it is approaching $35 trillion, and we have GDP, which just recently had its largest quarterly drop in US history. We can very clearly see that as the markets are reaching all-time highs, we're having GDP go in the opposite direction. So this is creating a very concerning divergence that is very alarming as a long-term investor. The last reason that I'm currently very bearish on the US stock market is because we are so reliant right now on debt and more stimulus. And the fact of the matter is, I personally do not think that the Federal Reserve and the government can just buy us out of a recession. With that being said, let me share two things I think everyone should keep their eyes on as things continue to progress. First off, there's another massive stimulus package that's being discussed right now in DC. This is making big news, especially since the added $600 unemployment benefits stopped at the end of July. And so people are wondering, where is the next government assistance and stimulus going to come from, since the economy is still battered and businesses are on the brink of bankruptcy. According to MSN, on Friday, the Trump administration rejected another $2 trillion stimulus package as Republicans and Democrats are fighting between having more and more government spending or not. We've already had over $6 trillion worth of government spending and also Federal Reserve purchases in order to prop up the real economy and also prop up the financial economy. I personally believe that a lot of this stimulus, while some of it may be justified, is really conditioning people to become reliant and dependent on the state. It's also important to remember that the government isn't some kind of rich entity that has a bunch of cash stashed away in a vault ready to deploy on a rainy day. The government doesn't really have any money per se. It has to borrow just like you and me. And so this results in more and more debt that we accrue as a nation. And it also results in higher taxation in the future. In addition, as the government borrows and creates currency today by getting deeper and deeper into debt in order to fulfill some of these massive trillion-dollar stimulus packages, this ultimately dilutes the value of the currency that we have in our system today. This is why we can't just double the currency supply and print tens of trillions of dollars and just hand them out to everyone, because the dollar would crash, prices would rise extremely fast, and ultimately there would be massive economic consequences. Anyways, as far as the stimulus talks go, I'm going to keep my eyes on whether Democrats and Republicans can come to a compromise and continue to dish out these massive stimulus packages. If a stimulus package reaches an agreement in the next few days or weeks, then I think this will help the stock market stay afloat in the short term. However, this would not change my medium-term outlook on the US stock market. I think there is a lot of risk in holding US equities probably for the next several years until things finally start to recover fundamentally in our economy. Next, I'm going to be keeping an eye on what the Federal Reserve is doing and not just what they're saying. Jerome Powell, the Federal Reserve Chairman, has already made it very clear that the Federal Reserve plans on keeping interest rates at 0% until 2022. As I've talked about in previous videos, if interest rates were raised much higher, then the US would basically be rendered insolvent because they wouldn't be able to pay the interest payments on the rapidly growing US national debt. If interest rates were lowered below 0%, then this could have disastrous effects to the financial system and the repo market, with banks loaning money back and forth to each other overnight. And so this could actually crash the entire financial system. No one knows exactly what the effects would be in the US if interest rates went below 0%, because it's never happened in the United States before. However, the Federal Reserve has been very clear that they don't want to see what would happen, and they want to keep 0% as the floor for interest rates. Given that the Federal Reserve does not want to lower interest rates any further, the only other tool that they have in order to intervene in the economy is to basically make asset purchases. This is quantitative easing, where they are taking those mortgage-backed securities or treasury bonds, and all they're doing is putting them on their balance sheet, and in that process, creating newly made currency and injecting that into the financial system in order to boost asset prices. This is a really convoluted process, but if you're interested in seeing how it works and all ties in together, then I'm going to link a video in the description below. It's a part of a larger series called Hidden Secrets of Money. It's by Mike Maloney, and I think this is the 4th episode that I'm referencing. And it's a really great video that explains how all of this craziness actually happens. Now, I'm not going to say works, but it explains how it happens with really helpful visuals. And so if you're interested, check that video out, and it's a great series. Anyways, if the stock market does start to slip and fall in the next couple weeks or months, I'm going to be looking at what the Federal Reserve does and whether or not they start doing massive asset purchases like they did in March. Anyways, I personally don't think that the Federal Reserve will be able to do enough, because if you look back at March, it wasn't until the government actually agreed on a stimulus package that the market finally bottomed. It doesn't matter what I think though, anything can happen. And so in my next video, we're going to talk about the 3 most likely stock market scenarios in the future and how we can all position ourselves in a way to be successful no matter which scenario actually takes place, so we can all be financially secure first and foremost and prosperous. Even if you are not invested in the US stock market currently, it'll be helpful to understand what's impacting the market and how this might influence other investment opportunities. If we understand what is really driving the US stock market and how this is impacting the condition of the US dollar and also the prices of commodities such as gold and silver, then we can start to figure out a way to build a balanced portfolio to hedge us against all the risks that we currently see. Again, no one knows exactly what's going to happen next, but it doesn't mean that we can't take information in today and start planning in order to do our best to preserve our hard-earned purchasing power. And so I'm so excited to start discussing this more in depth in the next video, and I will see you then.